Your credit score is not a single number, it's more like a mood ring that changes depending on who's looking at it and why. And if that doesn't make you slightly uncomfortable, buckle up, because the system is far stranger than you think. Most people walk around assuming they have one true score locked in a vault somewhere, maybe guarded by a tiny bureaucrat in a cardigan. But the reality is you have dozens of scores, each shaped by a different model, a different bureau, and a different industry's definition of trustworthy. It's not a conspiracy. It's just capitalism doing what capitalism does best, creating complexity where simplicity would have been perfectly fine. The two biggest players in this game are FICO and VantageScore, and together they run the show like rival fast food chains, both selling you the same basic idea, but with wildly different ingredients. FICO dominates the lending world, used by roughly 90% of top lenders, while VantageScore has been quietly muscling into mortgage and unsecured lending markets like the underdog that read the room. Here's where it gets interesting. These models don't just differ in name. They actually weigh your financial behavior differently, which means the same person can look like a gold star borrower under one model and a mild liability under another. FICO puts 35% of your score weight on payment history and 30% on amounts owed, while VantageScore 3.0 bumps payment history all the way up to 40% same data, very different conclusions. And if you thought it stopped there, it doesn't, because lenders also use specialized versions of these scores depending on what they're lending you money for. A mortgage lender might pull an older FICO version, think version 2, 4, or 5, while a car dealership is running a FICO auto score, a version literally tuned to predict how likely you are to miss a car payment specifically. You are being evaluated by a different algorithm depending on whether you want a house or a Honda, and almost nobody tells you this up front. Historically, people have treated their credit score like a GPA, one number that defines your worth, and that mindset has caused more anxiety than it has ever solved. The smarter play, the one financial insiders have quietly understood for years, is to stop obsessing over the exact 3 digits and start thinking in tiers, because jumping from fair to good on the credit scale unlocks meaningfully better rates in a way that going from 690 to 694 simply does not. The scores themselves are also not static monuments. They are living, breathing, fluctuating figures that can change week to week based on your latest credit card balance or a new application you forgot you submitted. Lenders report to the 3 major bureaus, Equifax, Experian, and TransUnion, on different schedules, which means your score on Monday and your score on Friday could be having completely different days with no dramatic life event required. A common misconception is that checking your own score hurts it, or that closing old accounts is a sign of financial responsibility. Both of these ideas are flatly wrong and have cost regular people real money in the form of higher interest rates. Checking your own score is a soft inquiry and affects nothing, and closing old accounts can actually shrink your available credit and spike your utilization ratio, which is the opposite of what you want. Speaking of utilization, keeping that number below 30% of your available credit is one of the most consistent levers you can pull across nearly every scoring model, and it's one of the few things in personal finance that delivers fairly fast results. Pay on time, keep balances low, and maintain a mix of account types, installment loans, revolving credit, and you are essentially doing the blocking and tackling that every model rewards, regardless of which version your lender happens to pull. The historical lesson here is not complicated. The people who got crushed in credit downturns weren't necessarily the ones who made one catastrophic mistake. They were often the ones who made a dozen small, uninformed decisions and then panicked when the consequences arrived. Discipline and process almost always outperform intuition and urgency, and that's as true for credit management as it is for investing or building anything long-term. There's also an angle most people never consider, which is that your credit score doesn't just follow you to the bank, it follows you to your insurance company, where it can quietly raise or lower your monthly premiums based on the same 3-digit logic. You could be paying more for car insurance or homeowners insurance right now because of a credit behavior you didn't even know was being tracked, which is either fascinating or infuriating, depending on how your morning is going. The philosophical truth underneath all of this is that credit scores are not a measure of your character, they're a measure of your patterns. And patterns can be changed with time, intention, and a refusal to let short-term noise distract you from long-term positioning. The score will fluctuate, the models will update, and new versions will roll out, but the fundamentals of financial behavior that the system rewards have remained remarkably consistent for decades. What's freeing about understanding this system is that it removes the mystery and replaces it with mechanics, and mechanics can be worked. You don't need a perfect score. You need a score that puts you in the tier, that gets you the outcome you're after. And that's a goal with a roadmap rather than a riddle. So whether you're just starting to build credit, trying to recover from a rough patch, or preparing to make a major purchase, the move is the same. Focus on the behaviors, not the number. Stay consistent and let the score follow. And if you're ready to put that credit to work, whether that's through real estate investing, home contracting, or connecting with the right lenders, check out our links in the description below and let us help you take that next step.